Welcome to this lecture on fraud prevention and detection. In this session, we'll explore how organizations use internal controls to prevent, detect, and respond to fraudulent activities, protecting assets, maintaining integrity, and preserving stakeholder trust. Fraud is the intentional deception for personal or organizational gain. It can take many forms, from financial misstatements and asset misappropriation to corruption and cyber fraud. The consequences of fraud are severe: financial losses, reputational damage, legal penalties, and erosion of public trust. That's why robust internal controls are essential in every organization. Fraud prevention starts with the control environment, the tone set by leadership. When management promotes ethical behavior, transparency, and accountability, employees are less likely to engage in misconduct. A strong code of ethics, regular communication of expectations, and visible disciplinary actions against violations all reinforce a culture of honesty. The fraud triangle, developed by criminologist Donald Cressy, helps us understand why fraud occurs. It includes three factors: pressure, opportunity, and rationalization. Pressure arises from personal or organizational demands, such as meeting financial targets. Opportunity exists when internal controls are weak or ineffective. Rationalization occurs when individuals justify unethical actions, convincing themselves that their behavior is acceptable. Effective internal controls aim to break this triangle by reducing opportunities, minimizing pressures, and discouraging rationalization through a culture of integrity. Let's discuss the main types of fraud organizations face. Financial statement fraud involves intentional misrepresentation of financial data, overstating revenue, understating expenses, or concealing liabilities. This type of fraud is particularly damaging because it misleads investors and regulators. Controls like segregation of duties, independent reviews, and audit trails help detect inconsistencies. Asset misappropriation occurs when employees steal cash, inventory, or other resources. Examples include skimming revenues, falsifying expense claims, or manipulating vendor payments. Preventive measures include reconciliation procedures, restricted access to assets, and surprise audits. Corruption includes bribery, kickbacks, and conflicts of interest. It typically involves collusion between employees and external parties. Controls such as vendor due diligence, approval hierarchies, and mandatory disclosures of related party transactions help mitigate this risk. Cyber fraud is a growing threat in today's digital environment. Phishing attacks, identity theft, and data manipulation can cause massive losses. IT controls, such as multi-factor authentication, intrusion detection systems, and data encryption, play a key role in preventing such incidents. Fraud prevention and detection rely on both preventive and detective controls. Preventive controls stop fraud before it happens. Examples include background checks during hiring, authorization requirements for transactions, and system access restrictions. Detective controls identify fraudulent activities after they occur, allowing for timely corrective action. Examples include reconciliations, exception reporting, and internal audits. Monitoring and data analytics have revolutionized fraud detection. Modern organizations use continuous monitoring systems to analyze transactions in real time and flag anomalies, such as duplicate payments, unusual expense patterns, or round-dollar transactions. Artificial intelligence and machine learning tools can detect complex fraud schemes that traditional audits might miss. Another critical element is whistleblower mechanisms. Employees are often the first to notice suspicious behavior. Anonymous reporting channels, such as hotlines or online portals, encourage them to speak up without fear of retaliation. The Sarbanes-Oxley Act even mandates whistleblower protection for employees of public companies. Let's consider a practical example. A multinational firm discovered fraudulent expense reimbursements through data analytics. Several employees had submitted identical taxi receipts across different departments. The system flagged the duplicates automatically, leading to an investigation and new controls, such as requiring digital receipts and automated matching. This case shows how proactive monitoring can prevent small frauds from growing into systemic issues. Training and awareness are also key. Fraud prevention is everyone's responsibility, not just auditors and compliance teams. Regular workshops, real-life examples, and open discussions about ethics reinforce the message that integrity is non-negotiable. When fraud is detected, a structured response is crucial. Organizations should follow a formal investigation process, collecting evidence, maintaining confidentiality, and involving legal counsel. Once the investigation is complete, lessons learned should be used to strengthen existing controls and prevent recurrence. To summarize, fraud prevention and detection depend on three pillars: ethical culture, strong internal controls, and continuous monitoring. By addressing the fraud triangle, reducing opportunities, alleviating pressures, and discouraging rationalization, organizations create an environment where honesty is the norm and misconduct is the exception. In our next lecture, we'll discuss segregation of duties and authorization controls, essential tools for preventing both errors and fraud by ensuring that no single individual has control over an entire process. Thank you for joining me in this session on fraud prevention and detection.